When you sign the paperwork for your car, your house, or your degree, the bank didn't lend you their money. They didn't lend you anyone else's money either. Because the money you borrowed didn't exist until the exact second your pen touched the paper. You didn't receive a loan, you created it. And they are charging you rent on your own creation. Welcome to the fractional reserve myth. 99% of people are playing a financial game using rules that institutions abandoned over 40 years ago. You were taught that banks are middlemen. You were told they take deposits from responsible savers, hold them safely in a vault, and lend them out to borrowers. That is a complete and utter lie. In modern Fiat IOU mechanics, the bank acts as an accounting clearinghouse. When you sit down and ask for a $300,000 mortgage, they do not go into the back room and check if they have $300,000 in cash. They simply type a $300,000 liability into your account and a $300,000 asset into theirs. The ledger balance is at zero. Through credit creation theory, your signature legally originated the value. The bank just monetized it. But here is the trap that keeps the middle class broke, exhausted, and stuck in the matrix. You are paying them interest to lease back the exact purchasing power you brought into existence. They assumed zero risk, created currency out of thin air, and legally bound you to trade your physical labor to pay them back. But it gets worse. Institutions don't look at debt as money. They look at it as a mechanism for time value arbitrage. They aren't harvesting your dollars. They are harvesting your time. Let's look at a standard 30-year mortgage at 7%. If you borrow $400,000, you don't pay back $400,000. Over the life of that loan, you pay back exactly $958,000. Over $500,000 is pure, unadulterated interest. That isn't just a number on a screen. Divide that $558,000 by your hourly wage after taxes. For the average earner, that is 15 to 20 years of physical labor. 2 decades of waking up early, commuting in traffic, and trading your life force just to service the cost of capital. The bank just used a shadow banking API to securitize 2 decades of your human energy and sold it to Wall Street before you even made your first payment. This is the reality of debt securitization. Your promissory note was immediately bundled into a mortgage-backed security and traded on the open market. To the financial system, you aren't a customer. You are the underlying asset. You are a dividend-producing stock, and the bank holds all the shares. And the cruelest part? Look at the amortization schedule. In the first 7 years of a standard 30-year loan, up to 85% of your payment isn't even touching your actual debt. It is purely servicing the bank's yield. This is exactly why banks constantly push you to refinance in year 5 or 6. They are resetting the amortization clock back to year 1, throwing you back into the 85% interest zone and trapping you in a perpetual state of wealth extraction. The retail mind tries to escape this trap by working overtime and cutting coupons. The institutional mind realizes you never should have been playing this game at all. Let me show you the cheat code. If debt is a trap for retail consumers, why do billionaires use institutional leverage strategies to take on hundreds of millions of dollars in debt? Because they understand retail liability inversion. Let's look at the math. This is the exact amortization schedule autopsy. The wealthy do not use debt to buy consumer goods, luxury cars, or primary residences that bleed cash. They use debt exclusively to acquire cash-flowing assets that yield a higher return than the interest rate of the borrowed currency. If true inflation is depreciating fiat currency at 5% a year, your real cost of borrowing at 7% is only 2%. If you buy an asset yielding 12%, you aren't just making a 5% nominal spread. You are capturing a massive 10% real spread. You are executing a flawless time value arbitrage. You use the bank's own credit creation mechanism against them. The revenue from the asset pays down the bank's debt. The tax code allows you to write off the interest as a business expense, entirely shielding your income. Meanwhile, inflation actively erodes the true purchasing power of the principal you owe. By the time the debt is paid off, the tenants or customers have covered the entire cost. The government gave you a tax break to do it, and you keep 100% of the equity. You just manufactured wealth out of thin air, using the exact same legal mechanics the bank used to enslave the middle class. So how do you stop being the harvested asset and start building your own autonomous wealth structure? You must execute a strict 5-step transition protocol. Step 1, sever the consumption trap. Stop borrowing to consume. If an item does not pay you a monthly yield, you pay cash or you do not buy it. Step, execute a full portfolio autopsy. I've built a custom debt autopsy calculator that will show you exactly how many hours of your life your current debt is costing you. I put the link in the description completely free. Run the numbers tonight. Step 3, build the liquidity buffer. The wealthy never face margin calls because they hold liquid reserves. Before you take on productive debt, you must hold enough cash to service that debt for 6 months without relying on the asset's yield. Step 4, separate your identity from your liability. The middle class borrows under their own social security number. The wealthy borrow through pass-through entities and LLC. You must begin shifting your financial footprint into corporate structures that protect your personal assets from catastrophic risk. Step 5, the yield depth inversion. You begin acquiring cash-flowing assets until the passive yield completely covers your remaining debt obligations and living expenses. The moment you cross that line, the matrix breaks. You stop working for money, and money starts working for you. But understanding how debt works and knowing how to leverage it is still only half the battle, because the financial system has another trapdoor built into the floorboards. A mechanism so quiet and so effective that it ensures even if you get completely out of debt, your savings are quietly drained away without you ever checking your bank account. It's called the Fiat Liquidity Siphon. And if you don't know how to protect your capital from it, every single thing we just talked about is completely useless. You will still end up broke. Click here and I will show you exactly what this siphon is, how it steals your purchasing power, and how the 1% systematically shield themselves from it. See you there.